Welcome back, guys. It's me, Adam. In this video, I want to talk about 3 different ways that we can buy the dip in big tech. So when I say big tech, I think of Facebook, Apple, Amazon, Microsoft, Google, Netflix, NVDA, and amongst different names, PayPal, all in the NASDAQ 100, which is right now at pretty much a bottom of a multi-month channel. So this could be a very nice buying opportunity, or there could be more pain ahead. But if you do decide to buy the dip, here are different ways that we can do so. So before we get into the video, if you're new to the channel, welcome aboard. Hit that subscribe button here at Unlimited Options Investing. We talk everything in the market from stocks, crypto, options, ETFs, as well as always, smash that like button, and guys, let's get started. Alright, so firstly, guys, let's take a look at the individual stocks. So first we have Apple, which was down 2.5% today. Over the last month, we've seen it down 11%, all the way up from about 157. Next, we have Microsoft, which is down 2% today at 283. Over the last month, it had a high of about 305 and is down about almost 6% over the past month. Netflix down 1.6% today, and this one's actually had a pretty decent month. I mean, all things considered in the market these days, this isn't so bad. Looking at Google, down 2% for the day, and over the past month, it's down 7.36% from an all-time high, with an all-time high just above 2,900, now trading at 2,673. Looking at Amazon, again, 2.85% down for the day. Over the past month, down 9%, hitting a high of pretty much 3,500. Facebook, this one's gotten pummeled, down 5% for the day. Over the past month, down 15% almost, pretty much. Absolutely detrimental for Facebook stock. And lastly, also down quite a bit today, NVDA down almost 5%. Over the past month, down 13%. We see it, guys, in the NASDAQ at 352 today. Over the past month, down 7.72%. And we see over the past year, there hasn't been that many pullbacks in the NASDAQ. And if there was, they were really short-lived and very shallow. So are we going to be seeing the same thing over here, or is the trend going to be broken even further? So the simplest way to be buying the dip on big technology today, guys, would be just to be buying Apple outright, Microsoft outright, Netflix, Alphabet, and just buying the shares, even though a couple of them are more expensive than the others, just buying them outright. And the second way that you could be buying the dip on technology is by buying an ETF. But let's say you want more concentrated exposure on that big technology versus the NASDAQ 100, which has 100 or so different stocks. And you can take a look at etfdb.com, and then you can search a specific stock and see which ETFs have the highest weightings in them. And it's convenient because it also has the expense ratio right next to it as well. What you'll find is a lot of big tech overlap in a lot of these big ETFs over here. And my favorite of all of them actually trades on the Toronto Stock Exchange, funny enough. And the ticker symbol is simply just TECH. And their allocations are simply Netflix, Google, Microsoft, Facebook, Apple, Amazon, within a couple of basis points of each other. And the third way that you can buy the dip on big technology is leverage. So the first way that I want to show you guys is by buying an ETF called QQQ, which are the ProShares Ultra Pro QQQ. And essentially what this does is it tracks the NASDAQ, but in 3x. So today, for example, the NASDAQ was down 2.1%. TQQQ was down 6.15%. However, on a day that the NASDAQ is up 2%, then TQQQ will be up 6%. Now, there are risks when it comes to these triple leveraged ETFs, because if you're holding for a really big downturn or a really big crash, black swan event, you could really get wiped out, because not always will this always recover the same way it did a year and a half ago. But let's say you bought at this peak and then you held all the way through until today, you'd still be up very nicely, but you also would have lost 70% of your investment. And if you're as familiar with losses as I am, when you lose, for example, 8%, you need to gain 8.7% to recover back to break even. When you lose 25%, you have to gain 33%. And so on to 50%, you have to gain 100%, etc. And lastly, the final way to buy the dip on technology, another form of leverage, my favorite, options, and particularly LEAPs, which are long-dated options that don't expire for at least a year. So I'm going to be taking a look at the January 2023 call options for all of these stocks. And assuming, let's say I would buy at the money strikes for all of them. So Apple right now is at about 140. Taking a look at the 140 call, I'd be paying $1,825 for roughly 45 to 50 Apple shares. Looking at Microsoft at the money, 283. So let's say 285. Let's round up. 285, January 2023. We'd be paying $3,450 for, again, 40 or 45 shares of Microsoft, which if you bought the shares outright, that would be a lot more expensive than if you just bought this leaps option over here, and so on for Netflix. Maybe not so much for Google and Amazon because they're so expensive. So for example, Google right now at the money would be, let's say, $2,700. So scrolling down to $2,700, we could buy leaps option. So again, 45 to 50 shares of Alphabet would be about $34,600. And you get the idea. It's a lot more affordable when the share price isn't over $2,500. And that's the end of my video. Thank you very much for watching. Let me know, guys, in the comments below, did you buy the dip in big tech, or are you waiting, or are you not touching? Are you buying in leverage, shares? Let me know, guys, in the comments below. As always, like, subscribe, and I will see you guys in the next video.